So I can't.
Okay. Yes. Welcome. Anyone, any question, please, before starting, if you like to ask. So very welcome. And then we'll start our lesson. This week we're looking at LO3, learning outcome 3. And previous lesson we cover LO1 and LO2. And this week, the third LO, and the following week we'll go through LO4, and then of course the last lesson will be about assignment discussion. Welcome everyone. Let's full start. Thanks for joining. So you can hear me properly. Okay. So this week, please, we're looking be able to apply taxation planning measures to minimize the tax liability. That's the key, in this learning outcome. And previously we Okay, so this week, please, we're looking at LO3, and last week, and the previous week, we discussed different ethics. We discussed 5 professional code of ethics. If you want to remember these, we discuss about popular people chat in office. And first P was the professional behavior, professional competencies, and due care, which is the up-to-date knowledge, competencies, and capabilities. We had a discussion, confidentiality, integrity, and objectivity. We discussed different finance acts, whichever you want to be follow for a case of example in your assignment, and you can apply the rates. We discuss about capital gain tax, inherent tax, and benefit, and we discussed the fuel claims, up to 10,045 pence, and we had a discussion all in the previous lesson. And this weekly, which is LO3, which is more focused on tax planning, and little bit discussion will be again on ethics. Legitimate tax planning is illegal, and grant issues in the taxation in UK. Those we'll try to relate, and we included the Finance Act 2024. Please, the rates is available, and if you want to be latest up to 31st January, normally we can. So then please we have assessment criteria 3.1, which is under LO4, evaluate the types of investment and expenditure resulting in the reduction in the tax liability. So of course, different expenditures, those we help, to reduce the tax liability, and the current annual investment allowance one-off. So that will help, to reduce. Every year the limit is increasing, and so please, we need to be ready, follow the Finance Act, and we can look around the rates, and of course, if we are using the software, normally software automatically updated, software company carry on updating and integrate through integration as a annual investment allowance. It can be 100% exempt up to million. So we can look around these like a plant machinery in last 12 month period, any expenditure in excess of this limit qualifying the written down allowance, which is 18 to, of course, we can look around for the categories of the asset. That we can, is this short life asset or any other. So we can look around reduce, increase the period of the, if it's a shorter or longer period, so you have to proportion it of these, allowance accordingly. Like if it's a 3 months, so the year end, so we can from 1 million, so we can say 250,000 is exempt. So let's look, examples we've been given. I included a few good examples from ACCA handouts, which I already shared with you in the previous lesson. And I included some examples, those I already shared you on our WhatsApp group. Please, you can follow. If you scroll down, you will find, different questions. So we can look around. Of course, we are aware of taxes. We've been given the man pool item, which is plant and machinery, 16,700. That was the previous week. The following transaction took place during the year. So purchase of the car, second car, and then purchase of the equipment, purchase of the car, purchase of car, and sold car. So we can look around. The car is purchased in April 2023, and the CO2 emission levels, of course, when we apply these, allowance, so we have to make sure we look on these. we put them under the right category that will help you. So we can look around the second car, 14 April and sold 12 December. So CO2 emission 75 gram, which we can look around as in that case emission level. So we can look around the purchase on the 2nd September, CO2 emission 45. So then the car 4 on the 19th November. So we can look around and we can proportion them accordingly. Let's look in this particular example. So year ending on the 31st March, and we can look around the written down allowance, how much was the previous, the man pool assets, 16,700. Additionally, qualifying for annual investment allowance, the equipment which we bought, so we can look around, this can be fully qualified, 98,750. So that can be, because we have a limit up to 1 million, and then others, addition, we have a car, so which is 15,600. The second car, we have to look around the car. We can look around special pool, so those are the emission levels is very low, so we can, and third car, if we use, then those we can look around and put them into according to the pool. So 28,300, 15,600, 10,100. So please, the previous car which we look around, if being disposed of, so we can look around, we can take out, and written down allowance is 18%, which we can, and those which we can calculate 18% from the man pool. Yes, so we can look around 18% from the car section, and then we can look around the special pool, which is can be, so we can look around again the according to the proportion, and then of course that's the allowance we have authorized. So we can look around additional qualifying for the first year allowance, so the remaining which we can, the car for, it can be further because it can be first year fully allowance, because the emission level becomes less than 45 or 45, so we need to be look around those in qualifying. And then please, you see there are written down allowance these values that will carry on brought forward, carry forward these accordingly, and we have a total allowance 126. So we can look around these, and that's if your bill is up to that point, so we can minus, so that's you saving on the taxes. That's we can look around. The car is kept separately because there is a private use by then the car at the CO2 emission level 1 to 50 grams per kilometer. So we can look around qualifying written down allowance is 18% in that case. The car CO2 over 50 grams, so therefore the qualifying written down allowance, the rate is 6%, even though it is only asset in the special pool. There is a no balancing allowance on the disposal of this car, so we have to look back in the rules, because every year carry on publishing, and if the car emission level 1 to 50 and therefore qualifying for the written down allowance is 18% of the man pool, and the car for CO2 emission therefore qualify for 100% zero CO2 emission in that case. It's like the electric cars as well. So new car with the zero emission qualify the 100% first year allowance. So please, that's which is quite good when you're looking the tax planning side. So we can advise client, your tax bill is expected this one, and of course, if you thinking about planning is illegal, of course, we can give advice to, and that's if we can. And if provided the company car and 2% of the car benefit percentage is available, and there is a minimal income tax implication for the employees, and only very small amount of the class 1 national insurance contribution payable for the employers, and providing the no emission car, the company car. We have to look around those perspectives 100% in terms of shares and things which we can look around allowance there as well. Structure and the building allowances, those we need to be look around. That's unchanged in 3% relief available, being over 33.5 years we can. So please, those approximately we can look around. Of course, structure and the building allowance, which we can where it's been constructed on after the 29th October and up to that point. So we have to look around those qualifying periods for limited company, because a lot of things, limited company is favorable for them. But now, of course, look around the new tax, this year's budget, and of course, from 1st April onward, we can look around the finance sector. So please, we need to be look around again. This is one of example which we can look around. The 1st July, the company purchased a newly constructed factory for the building for 470,000, including the land. Of course, we have to look around the land value. You have to look around factory brought into the 1st September. The qualifying expenditures for structured building allowance is 360,000, and the value is 470,000. So we can minus that, and then of course we can look around the difference, please. And the factory is being brought into 1st September 2023, and then of course we can look around the period, and then to leave 3% of that, and 3% of 360,000 times by 7, because 7 months is remaining from 1st September to 31st. So we have to look around those proportionately. An allowance of 10,800 that will be given in the subsequent year. So we have to look around those accordingly, and we have to make the adjustment. Okay. So please, we have a separate chapter on capital allowance in the various scenarios. Please, we have to look around. We have to look around the capital, which asset, which allowance is qualified, and which categories we have to put them, and then we can claim it. So original cost of the asset, cumulative, the capital allowance claim, which is already been claimed, you minus the written down value, and disposal, and if you dispose of the asset, the balancing allowance, which we can the charge, and the financial management term continues, if it's the internationalization, the term capital allowance and written down allowance. Sometime, being replaced by the tax allowance, depreciation, and all these, the term can be used interchangeably. Of course, we can't really normally claim a depreciation, but we can claim the capital allowance, because that's the key purpose, because the value of the asset carry on. And timing of the asset purchase, of course, we need to be proportion them accordingly, 3 months, 4 months, 5 months, 7 months, and the allowance, so we need to be look around that accounting period, the start and T1, not in all period, we need to be look around laying out. And of course, the question can be in the long run, net present value of the assets, written down allowance, those we can claim. So pension and other tax efficient, investment product, which we can look around as well. Of course, enterprise investment scheme. These can be some special scheme and special tax the reduction schemes, so we have to look around those perspectives. The loan relief, of course, qualifying period. So we have to look around these. And 3.2 legitimate tax planning. Let's, look. In this case, we have the husband and wife, in that case, married couple, the tax year for 2023-24. Salary is 90,000, of course, the higher taxpayer, and Samantha salary is 30,000, and the saving income 1,500. Samantha's basic taxpayer, so her saving nil rate band is 1,000 in that case, because if you're earning up to 37,700 after the personal allowance, so you fall under the basic tax rate, and the remaining 500 of the saving income will be taxed at the rate of 20%, and the rate of higher taxpayer. So the saving income is a nil rate band is 500 in that case, because the higher is the 40%, additionally is 45. So we have to think about, so 500, if we transfer the saving to husband name, and that's, then of course, will be the saving around, £100 can be if we transfer. So of course, tax planning is illegal. We can advise to clients. So dividend first year is 1,000, please. The dividend income, then the benefit from 0% rate, so will be available for the taxpayer regardless of the paid tax, the basic, higher, or additional rate. However, the dividend nil rate can count towards the basic rate in the higher rate. So we have to look around the dividend income excess of 1,000 nil band is taxed at 8%. 75, if the fall lower than the base rate threshold 37,700, then please we can look around. If it's about 33.75, it's 32.75 now, so we have to look around those perspective and the rates, and then we need to be calculated accordingly. Of course, if you're a higher taxpayer, if additional tax, so we can look around 125 or 140. That's now is linking this limit to the visas as well now. Okay. The new visa policies, the proposal is in place. That's going to be implemented from next year, April, and that's, higher taxpayer can get indefinite leave to remain in 3 years instead of 5 years, and those are say less than that. It goes up to 10 years, maybe 20. Okay, so that's any question, like, please, if you like to ask. Okay.
So we had discussed this is mostly the how it does impact on the individuals, isn't it? So how can we make better way plan for the individuals? So how can we do this one better for the business and the self-employed? So in terms of making a legitimate tax planning.
Yeah, it's a legitimate. If they have a loss, they can be carried forward up to 5 years. If they have outstanding liability, they can go backward 5 years as well. Carry forward and backward if they have a tax liability outstanding.
Okay. So in terms of the maximizing the deduction, especially in the business, so what should what kind of the steps they can take for a business like the small to medium enterprise?
Yes, always. Let's say someone bill is £20,000 first suppose, yes, and they have still old cars and they are using it and they're supposed to pay 20,000. So what can be suggestions? The electric car they buy, and they can collect first year full allowance, yes. So it means they don't have to pay the tax, but they have the asset now. Yes.
Okay. Yeah. Good example.
First year, so tax planning we can advise those perspectives.
Okay. Yeah. Good advice. Yeah.
Okay. So yes, please. Any other question? Very welcome. And as much of course, other nitty-gritties can be goes according to the scenario. Sometimes individuals. So that's when we look in this example, the salary is 62,500, the dividend income is 2,800. Her income tax liability we want to calculate. Employment income is 62,500, and then dividend income is there, and the total income is there. So what we need can look around the personal allowance first from the employment income, which is 12,570. Still, the government kept as it is, and the national minimum wage, of course, going up, now from 1st of April. So, of course, the budget release, of course, is if you want to attend some events, please, if you go IFA direct, you're a member as a student, and you can attend, those events. That will help you because, of course, tax expert, people, those are dealing day in and out, their scenarios. So, plenty of, good examples can be those we can embed, but I'll carry on sharing with you. And the 37,700 at 20%, and the remaining will be 40%. Yes, tax. And then, of course, when we look at dividend, first 1,000 is 0. The remaining will be 13.75% because this person is a higher taxpayer, not the basic taxpayer. So we have to look around that perspective. So then in that case, the total liability will be here, which we can look around. 13,000 is 40, and of course, when we look there, the salary is the separate. So we have to look around the tax liability. Salary is 49,930, so we'll pay the first 37,700 will be 20%. That's 7,540, and the remaining 12,240 will be taxed at 40%. And then we look the first 1,000 in dividend is 0, and the next 1,800 will be 30.75 according to the IES, the Finance Act. So we if we look now is 32.75. So we have to look around these, and we can think about, maybe we can say, come on, dividend don't withdraw because you're paying 33 point, yes. And then of course in the next year you can do again, depends, yeah. And if it's partners, and so we can look around those perspectives. Okay, so I included further example here as well, employment and the dividend, exactly the same. So good few examples which we can look around the nil, the band and the income, and that's all those we need to be. In that case, it's 31 for the 30, that's the 20% tax, then when we look, the dividend income is 8,500. So the basic taxpayer in that case, first 1,000 will be 0%. Then next, 5,270, because that's, up to the point, the higher tax rates apply. 8.75% dividend rate, of course, if when become a additional, when it become a higher tax rate, so that will go stay. The dividend rate is 33.75. So that will go to instead of 40. That's which we need to be, so we can look around it. Okay, of course we can look around the saving income, interest, the trade losses and adjustments. So then we included again example here, please. Employment income is 47,700, the saving income 2,000, dividend income is there. Then of course we have to look around it. The person is a basic taxpayer, 12,570, we minus 34. So because it's less than 37,700, the 20% tax will be applied straight away. And then please, when we go saving, because is basic taxpayer. So first 500 in that case is exempt. Remaining 1,500 will be 20% tax. The basic rate, the dividend will be first 1,000, and the remaining will be, because now we're moving toward the higher rate. So that's the way we need to be. So if the saving income transfer has been right, and those we can, and others we need to be look around the relief and the profit and qualifying period. Those we need to be carry forward reliefs. Yes, the loss is up to 5 years, and of course we have to be look around that back forward. So these, please, we can look around the, of course, corporation tax is 19%. We have to look around the qualifying, the capital allowance and those, and the charter accounting period at the longer, we need to be divided accordingly, and the tax year we need to be calculate. Of course, we have to look around the scenario, and then of course, we need to be like we discussed about. Yes, here is a question mark, research and development expenditures as well. So we have to think about, in terms of the tax law, because normally when we say development, what is the definition of asset? Asset is mean anything you own it which flow the future economic benefit. And if we can measure reliably, if we treat as an asset, we generate asset from, and the first year allowance can be applied that case. Otherwise, the revenue expenditures we can minus from a profit, so we have to look around those prospective capital and revenue. IR 35, yes, of course, nowadays, legislation often call IR 35 after the press release. So personal services companies, so have to be just, one shareholder to use to provide his services. That's, we have to, nowadays, we have to inform to even, the details to HMRC, and of course, the adjustment those need to be like now, but in various other lot of legislation changes. We need to be further look their new legislation in that perspective before we give the clients advice. But of course, okay. So then 3.3, evaluate the mitigating the tax individual and the business. When you providing the tax planning advice to the clients, you are fully responsible for the advice you gave, the fundamental principle, professional competencies and due care, which we discussed. HMRC, of course, insurance is also is quite crucial, with protection against, sometime advice, of course, we'll try our best to be in the light of, the information we know. We need to be look around professional code of ethics. Those we discuss tax evasion, and those, of course, the attempt to be that the fundamental principle integrity can be. So we have to think about moral principle and the legal the rules as well in the when we're giving advice, because sometimes the moral it's come so like the prime minister wife paid tax abroad. So that was the question about that some ethical issues, not just she not break the law, but the obligation to be the country or the wider interest of societies. We can look around those perspectives. Direct taxes avoidance scheme different can be, and so we have to look around those, a person that fall comply with the disclosure of the provision of the liable penalties and not exceeding than 5,000. So you have to think about those likelihood of the things, like a legal sometime, so we have to think about in those perspective. Value added tax scheme, please. Again, we have to look around the threshold, please. Either is the cash accounting, annual accounting, flat rate, standard rate. So those we can look around these schemes, and then of course we can plan the things. Each have some advantages and disadvantages. Sometimes we have to look around the penalties and the interest and the period, maybe the cash flow issues. Sometimes people do, but here is come sometimes maybe not including the certain invoices, the VAT returns, and then of course submitting and accepting the errors that happened in the previously. And next 3 months we can adjust it when the next return happen. But here is the question: if we're doing intentionally, it come under fraud. When it's mistake, of course, is no. Then of course ethical some issues we can look around those perspectives. Okay, so 3.1M, if you want to work towards merit criteria, we can include some examples, please. Of course, including more examples are good compare, contrast, different authors' view that we can hit the criteria of merit. So please, some ethical issues. Like, if somebody asks you, you save my tax, I'll pay you half my tax saving. Let's say you saving my 9,000, half is 4.5 yours, 4.5 mine. Can we make this agreement as a accountant?
No,
What do you think? No,
I
of
don't
course.
think so. No,
We
unethical.
we charge hourly rate, the services we provide, whatever fees we charge, by law, but we can't say condition attached with it. Yes, not conditionally fees. We can't. So that's we need to be careful, because that's we can compromise the professional code of ethics. Of course, end of the day, the evidence. That's it. And sometimes inspector can visit us, and we can keep the record of course the record keeping is one of the crucial. Of course, sometimes it's very hard. No, of course, digital tool, digital devices scanning, as long as much evidence we can keep for the client versus up to 5 years. So please, we need to be look around. Fundamental principle: integrity, objectivity, yes, professional. These we can look around. Of course, we can disclose of the information. Of course, we have to look around in the wider interest of society. Of course, we have NCAs and various others, the tax, the avoidance schemes. So we have to think about those perspectives, different VAT schemes, please, and the salary taxes. Sometimes people expect it to be a closed company instead of doing all this, because that's cheaper. That's why now the company house and all, they are increasing the pieces and setting up the new companies. Of course, in the footprint and the director even closing, still we have to submit the return. Tax planning is illegal. Of course, money laundering, those we have to look around the bribery, holding stolen goods, the client money in your account. So you can't really put the client money. So you could, technically it's supposed to be separate account, business account, and the client holding, because otherwise it's showing your business instead of others. So we have to look around these all and disclosure. These are different schemes which we can look around. Of course, when we dealing with the ethics side, self-interest, so back end commission, like Glasgow Smith client getting used to pay the commission to the doctor. Doctors supposed to be give advice to patient, whatever the medicine, not for the sake of the commission is getting. So that's the self-interest. Their code of ethics can be compromised. You checking your own work, maybe working in audit and others. There also be integrity and objectivity. If we know each other very well, number of years, sometimes the familiarity threads and can be objectivity, can be our integrity, can be compromised. Those we have to look around. Intimidation, if we don't include this in why this if we include this invoice this quarter in the VAT return, what will be happen? It impact our cash flow. So what we'll do, we'll leave it, and that's otherwise your and my job will be at risk. So that's intimidation. So we have to think about those perspectives. If you're giving advice to clients and both are they competing each other and they are going to be taking about mergers or whatever. So if you're giving one advice and if you give others advice. So you have to draw the safeguard. Maybe you give advice to one client, your other colleague will or someone else are maybe because even if we say no, because you both are my client, then confidentiality maybe we are going to break. So you have to be sometime is very so we have to think the safeguarding perspective, and of course we have to either member in practice and member in businesses. Safeguard is the key. We need to be good internal control policies, procedures, like signing things, yes, even submitting tax return, sending to them, say confirm it, sign it underneath, and then we can submit it and we can download that, we can save it as evidence. Okay, review the current taxation. Of course, we can look around current. Of course, at the moment, think about a lot of rules is changing towards. So, if anything, you including these grant issues, tax planning, tax avoidance, are different schemes. So we have to think about disclosing. Now the saving income. Now look around. Uh, they are reducing the threshold for you know, investment in savings schemes. So those, if we adding the examples, so we are meeting the criteria. Otherwise, I'll give you a few examples. I included just this from one of F's exam papers. So please see the handout. We already sent it in we send you and we around the question. And please, we have the chapter is good to be look around. It's called personal allowance, please. Capital allowance, yes. Sorry, capital allowance, not personal allowance, can be individual. And that, is good to look around. So today we cover our LO3, and the next week we look LO4, which is more about the stakeholders communication, sharing information, and then we will go through in next lesson in and stakeholder stuff, and the following week then we'll do the assignment discussion. So that's all from my end. Anyone any question, please, if you like to ask, very welcome. Hello. Yes. Anyone like to ask any question, or are you okay? If no question, we'll keep up to here in the next lesson.
It's about the text. Hello, can you hear me? Can you hear me?
Yes, I can.
Yeah, one quick question.
Yes, sure. Please.
Yeah, I'm just got one question. Hi. It's about the tax mitigation one. Obviously, we have the tax mitigation for individuals and the businesses. I know there's certain methods we had applied to reduce the tax. As is coming through, and it's basically making it really hard to save money for the clients. So in terms of the making a obviously there's is with ethical. I'm saying that ethically, how can we save more tax for the individuals? Which one is the quickest and easiest way to do this one for individuals and for the business?
Okay, that's a bit sometimes really tax. Sometimes clients don't want to pay the tax rate. They think accountant need to be even. Some pieces can be issues even we want to charge a fee. So really we need to be look around. That's all. If we have well before advice, well before we know them at the start of the year, yes, then we can plan. We can advise them. But if everything is a happen now at the end of the year, and they come to us, before 31st January, so it's very hard. We can go backward now. Then it's mean because everything is showing in their statement. Of course, even is whatever sort of, even we have invoices and things. Then of course it can be quite immoral, we can say, it's illegal, we can say. You can include this advice or that even come under fraud. Yes, it can be NCR. That's so we have to think about that money laundering perspective as well. Yes. Yes, if they are buying something now,
Okay.
maybe
Yeah. No.
we can say them in future what they can do to do things like, sometime now is a
Mhm.
question mark pay on accounts. If your bill is more than 1,000, so HMRC is charging no advance tax for the next year. So before 31st January this
Mhm.
year, the current year is going to be finished, of course, 31st onward April. Yes. So what we need to be think now, if they move to the company instead of sole trader and then they do through companies thing, then of course, that thing is goes to
Oh,
the
yeah. Oh, that's a good idea.
yeah. So that
Yeah.
can be
Yeah.
the choice.
Yeah. Yeah.
Otherwise, it's
Mhm.
very difficult. Of course, we can look around our own values, but of the course, client and businesses, sometimes it's a very difficult to be balanced. But we
Mhm.
have to look around those both perspective in a legal means.
Yep. Yeah. Okay. And okay. In terms of like incentives or reliefs, we can add into obviously like if there is any research and
Yes,
development, we can
let's
use.
let's
Yeah.
say someone is working from home,
Mhm.
yeah, using the business registered from home. They do make call. The clients come at their place. Yes, we can include some proportion of the expenses. The word is reasonable. Yes,
Yep.
reasonable, which
Mhm.
can justify. Then of course that's the legal side of it. Yes, or someone using
Okay.
more,
Yep.
using for personal use and using for business purposes, so you can proportion it but not half it. So just think
Mhm.
how often you use, just a few questions you use, I mean, the professional judgment, you can say, in the other words. That's the way you can,
Mhm.
some expenses you can justify. My client told me, I wrote it everything, would get the signature of my clients, so he told me he don't have evidence. He has the evidence as a whole council tax bill. Yes, but it's
Mhm.
not on
Yep.
business net. He's doing from home. His business is registered. He using one room, so one room council tax can be put as expense.
Mhm. Yeah. Thank you.
Welcome.
Yeah. Uh, yeah.
Anyone?
That's it from me.
Yes, please. Any other question?
No, that's it. Thank you.
Okay,
No other
thank you.
question.
We'll see
Thank
you
you,
next
Professor.
week. And thank
Mm.
you. Thank you. Have a lovely weekend. And
You
we'll
too.
go.
You too as well. Have a lovely weekend to you.
Thank you.